We all know that everything you've been doing for the past 3 years, everything that regulators have been doing since the crisis, was to make a bank like yours, right, was to prepare it really for balance sheet stress, to prepare it for market volatility. We've got both. How's it going?
Well, I think, if you look at how we came out of 2015, and 2015 wasn't the easiest of years. Came out with record earnings since 2006. We put targets out 3 years ago. We hit those targets. I think we managed the institution pretty well in a challenging environment. And now we've got to show that the work we've done in terms of changing, of a radical transformation of Citi into today a bank, not an insurance company, not an asset manager, is a different company. And that when the markets get volatile, we're managing the place right.
Well, let's talk about the way the market views you. When emerging markets get hit, and certainly they've been hit hard now, Citigroup gets hit harder than the rest of the street. We continue to almost look at Citi as a proxy for the emerging markets. Is that a true story, or are we looking at Citi in the wrong way?
No, I think people are looking at Citi the wrong way, but that's true. I think, to use your words, people do view us or have viewed us as a proxy because we are a global. We are the world's global bank, and so we have exposures in those places, but what we've got to do is we've got to break that cycle and show people that whether it's China, whether it's oil, that we do have exposures, but they're completely in line and in size with who we are and what we do.
So you are not vulnerable. If we see China take another leg down, Brazil, other emerging markets, you will be okay?
Well, we talked about, yes, we'll be okay. We talked about on the earnings call, if you look at China, about 1% of our assets are in China. If you look at energy, 3% of our loan book, our total loan exposure is in energy. And that exposure to our clients are largely investment-grade multinational oil companies. And so the markets have tried to punish us for that, and we've got to prove them wrong.
Speaking of punishing markets, 5 weeks ago, Janet Yellen and her colleagues at the Fed felt that on the basis of strength in the labor market and perhaps expectations for a little inflation, raising interest rates a quarter point was the right thing to do. Mike, are we going to look back at that decision and say it was a mistake?
I think it was necessary for the Fed to do. That the Fed's credibility in some ways was on the line. And if they didn't do it then, when would they do it? So if I was in the room and had the same information, I probably would have made the same decision the Fed made. That being said, since then, or at that time, a downdraft in terms of oil, growing fears of a slowing China, those things have continued to exacerbate. So what we're going through, we don't see this as a big fundamental shift in terms of the markets, but there's absolutely a repricing.
Do you think should she raise again?
Yeah.
I'm sorry?
Should she raise again, or should she hold off?
I think they should wait. I think they should wait and watch and see. And if you look, at the time they raised rates, we thought we'd probably see 4 rate hikes in the course of 16. That's moved now back to 3. Some people are talking to 2, and even some are starting to talk that the next move is down, not up. So I think we've got to have a bit of a wait-and-see attitude here.
It sounds like a crazy question to some. Do you think there's a possibility at this time next year we'll be talking about, or perhaps even seeing, QE4?
We don't see today. There is talk of fears of recession. We don't see that as of right now in the U.S. We've got a healthy, recovering consumer. You look at what happens, in many ways, the purest form of stimulus is the reduction of oil prices, gasoline, the average American family. Those numbers flow through. That allows about $100 billion of spend a year. Purest form, that is in the paychecks, in the wallets of our population, and we've got to make sure they have the confidence to put that to work. We've seen a bit of it, but we've got to get more of it.
China, UBS and Credit Suisse are going big. They're leaning into China, and you said you've only got 1% exposure. How do you see things different than they do?
Well, we operate in China like we operate in many places around the world. We've got an institutional bank. We've got a consumer bank. We service high credit quality customers. We're there with the multinationals that are doing business in China. We're helping the outbound Chinese champions go around the world as they expand and do the things they do. And then we run a consumer bank where we're lending, we're offering credit card products, again, to what we see as very credit-worthy customers.
In terms of your investment bank, M&A, you're ranked number 5, according to Bloomberg data. So you got some wood to chop. What are you going to do there?
Well, M&A is a business that, depending on deals, you're up and down the league table. So we punch anywhere typically from 3 to 5. And so we think we've got a good backlog. We think M&A stays active, that it's going to be an important tool in the toolbox of corporate CEOs as growth probably stays tough. And if you look at what's happened in the markets, maybe some valuations just got better.
There you go.
Mike, the Europeans are leaning into China. They're leaning out of fixed income, right? So Credit Suisse, UBS, Deutsche Bank, Barclays.
U.S., Morgan Stanley.
Yes, Morgan Stanley is scaling back. Even Goldman Sachs is cutting. Is that going to make fixed income a more profitable business for the firms like yours that stay in it?
Yeah, if you look at what's going on in Europe, a lot of those institutions probably end up being constrained by leverage ratios. Mm-hmm. And the two things you think about is the leverage ratio a constraint, or do we have scale, or do we have a pathway to scale? And I think largely you've seen people who've been pulling back really focused on those two things. We think that creates an opportunity for us. We have an upscale presence. We don't have a leverage ratio as a binding constraint, and so we've continued to take share in those markets.
Given that some of those very same firms are now prioritizing equities as they retreat from fixed income, does it make it more sensible for you to put your eggs in the fixed income basket and maybe not compete in a more intensely competitive equities business?
Well, we already have our eggs in the fixed income basket, and we're going to continue to invest in that business, but we've punched below our weight in terms of equity.
So what do you do?
So we've invested in people, we've invested in technology, we've invested in research, and we've got to raise our standings. And again, to set the bar here, we're not shooting to displace somebody at number one, but we can move up. And what we talked about, a couple places in that league table is probably worth, somewhere in the hundreds of billions of dollars of revenue.
With cost cutting being a priority, why does it make sense to invest in research, publishing research? More and more have said it doesn't provide great value and customers don't pay for it.
Well, customers do pay for it. I think if you look at the polls and you look at the surveys, customers don't pay for bad research, they pay for good research.
But why would a good research analyst want to work at a bank right now, given that people inside of banks have gotten repriced? Why wouldn't a research analyst with a good idea work on the buy side where he can truly get paid for it, or she?
Well, when you look at our platform, we're going to give that analyst access to investors that they're probably not going to get access to in other places. So on Citi's platform, you're not just going to be accessing investors in the U.S., but in Europe, in Asia, in Latin America, and you're going to be able to tell your story. And to a research analyst, getting their name out there, being recognized, and being recognized not just locally, but globally, is something we can offer.
Mike, the dominant feature of the banking landscape for the past 8 years has been regulation. You've had your share of it. Are you getting ready for Basel IV yet?
No. That if you look at really what's happened, and in particular in the U.S., in many ways, we've moved past Basel, and today it's largely stress test based. When we think about our institution, it's the scenarios that we provide ourselves, it's the scenarios that the Fed creates, and when we run our institution, we're running it to a lot of different metrics, whether it's leverage ratio, whether it's Basel, whether it's CCAR capital. And so, at least for now in the U.S., I think CCAR and stress testing has taken the place of Basel IV.
And regulation is largely done?
I would say the creation of new regulation is largely done. We've still got implementation when you think about where we are in Volcker, where we are in some of those other things. The implementation's still ongoing, but we believe you've seen the bulk of what's coming in terms of new regulation.
Or he's certainly hoping that.
Definitely hoping.
Mike, thank you so much for joining us. That is Michael Corbat. He's CEO of Citigroup.